Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show, and boy oh boy, what a volatile week. That seems to be the new commonality for these markets, and that is indecision, people, investors, companies not really knowing what to do, not really having a good outlook on even where policy is going, especially in the US, to make decisions. And markets, they're reflecting that with a ton of volatility. On this weekend show, we're going to focus on more big picture, what's happening in the markets, also tying in the currency markets, the bond market. They're all telling, I think, a pretty defined story here of money potentially exiting the U.S., and who knows for how long that might be. And the big standout being the safe haven of the precious metals, gold especially. A lot for us to get to, and a lot that we have also talked about throughout the week on daily editorials, on our website, podcast, and YouTube channel. So please, everyone, go check those out, comment, like, and subscribe. Without further ado, let's get into this weekend show, kicking off the show with Rick Bensignor, president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail individual side, something that I think interests even more of our listeners, check out In the No Trader website. I'll post a link to that in the show notes. Rick has a number of different products, one being the weekly report called the Tactical Trader and a daily report called the Daily Tip Sheet. Rick, let's start off broadly with this volatility concept here. Markets in this week, this last week, started off very negative and then had almost a record-breaking rebound when we heard the tariffs were paused for 90 days and then turned back around. Overall, it seems like the trend is lower, but volatility reigns supreme. Rick, what do you take away from this market environment?
First of all, what do you mean volatility? There's no volatility.
Oh, man, this is crazy. The VIX is at 50, Rick.
Yeah. All right. So let's talk about, we'll talk about vol, but let's kind of talk about what's going on in the markets in the sense of how fast things are moving and the inability for people to react to what's going on unless they're literally in front of their screens all day long, every day, which means basically full-time staring at your screen, which is not what most of us want to do in life. But just to give you an example, let's go back a couple days ago to when Trump kind of pulled back on the tariffs. I think that was Wednesday, but I can't even remember anymore because stuff's happening so fast. In the first 2 minutes after he made that announcement, and I'm just literally looking at it right now. So I want to show, and let's talk about this. All right. The low in the spiders of when he made that announcement, spiders were trading at $4.99. 120 seconds later, this reached as high as $5.22. That's just insane. In 2 minutes, you realize that if we're talking, what did we say? 499 was, yeah, 499. So 23 points in 2 minutes. That's 230 S&P points. That's almost 5% in 120 seconds. Nobody got a chance to do anything for obviously several minutes after, at which point you're paying up 6% or more than where the market was 3 minutes to 5 minutes earlier. It's insane what's going on. The only people who can react to that stuff as fast as they can are the algorithms, who instantaneously, they are monitoring news feeds all day long. And they pick this up way faster than anybody else can. And think about this too. You're sitting at home watching CNBC, let's say, or Bloomberg, any of these business channels. I know for me, at my particular feed, sitting at home watching, I am 45 seconds behind the actual time, right? And that's a lag both from the networks, from internet. So because every day at 4 o'clock, when the closing bell rings on my computer, which is literally exactly at 4 p.m., I see it does not close for 45 seconds later on CNBC. So I know that I'm almost a minute behind what's considered live. And in the scheme of things, you think, what's a minute? Well, now we know what a minute can mean. It can mean 20 handles in the S&Ps or more, right? It's insane what's happening. And the bottom line is, look, S&Ps are up right now as we're talking 34 points. That means, all right, so spiders are up roughly the same. Move the decimal over 1, right? So in and around, it's 1/10 of the move for spiders than what the actual cash S&P is. You cannot react fast enough to this stuff. And it takes nothing. If we're up 34 points now, in 20 seconds, we could be unchanged on the day right now. That's how things are moving. So as investors, you have to make a decision of how and what you want to do in an environment like this. You can choose to do nothing, which is what, of course, all the Wall Street firms hope you do, so that they continually manage your money. And although it's certainly less what they're managing than it was a month ago, to the tune of 10 to 20%, they still have you in and they're collecting their fees, which is why virtually no financial advisor ever says to you, sell, because it's a conflict of interest for them to tell you to sell. Because once they tell you to sell and you go into cash, they no longer can charge you on the assets they manage. So there's an inherent conflict to actually getting the advice that may seemingly be completely correct. So they've been taught to teach you, hang in there for the long run. We'll deal with the short-term volatility. And when they say we'll deal with it, generally, now this is not every single financial advisor. And one of my best friends is a financial advisor, and he's been selling, and he's been reducing exposure. But if you're the long-term buy and hold type person, they've got you convinced on a story that they've been saying for 50 years plus of buy and hold. You can't time the market. We'll deal with drawdowns for the long term. Well, it depends on what your investing horizon is, but between 2000 and 2012, the S&P was flat for 12 years. Had swings up and down, but it went nowhere for a dozen years. Buy and hold works if you're 30 years old. And I tell my kids all the time, don't worry about this because you actually want the market to go down. And they're like, Dad, what do you mean? We're losing money. I'm watching my 401k. And I said, yeah, I get it. But if it goes down, you get to buy cheaper. Let's assume 40 years from now, the market's going to be well higher. The best thing that can happen for you is that the market goes down while you're accumulating shares. And this is, of course, contrary to how the head thinks, which is you want to see your balance always, going higher and higher. But it also means every 2 weeks when your paycheck gets put into your 401k, you're paying higher and higher prices. So the whole psychology right now is thrown into turmoil because we don't know what's going to happen at any given moment. And I think President Trump has proven to us that at any time he can say something that dramatically changes the game in a heartbeat. So you can either choose, let's go back to what I first said, you can either choose to just sit through this, not watch your account balance every day, and just keep buying over time. And again, it's great if you're 30. If you're in your 60s or 70s or 80s, you're in a whole different ball game of what to do with something like this. And there, I think you have no choice but to do some reduction of risk in the market, simply because the downside now is potentially equal or not more to the upside in the next year or two. We don't know how long this tariff stuff is going to overhang the market, and how much of what Trump is doing is kind of a wrestling match of wits between him and President Xi of China. And we know that for years, there are periods of times that the market simply doesn't rally or falls. And you have to decide how you're going to want to deal with this. And it's a decision you probably should make pretty darn soon, because the tariff hold for 90 days now that Trump talked about a couple of days ago doesn't mean this is over. It just simply puts it on hold. And at any time that can change from either party. The levels of which the tariffs are being imposed by U.S. to China and China to U.S. are the point where all transactions would virtually stop between the two countries, because nobody can do business with tariffs of 125% to 145%, which is where they are now. And what I've told my children is, for the time being, reduce your discretionary expenditures as much as you can. Now, going to the supermarket to buy food, that's not discretionary, that's necessary. So that's not where you skimp. But maybe you buy hamburger instead of steak, and you figure out and you stop buying clothing that you don't need. The wants get put on hold. What's the worst that happens? You buy that pocketbook you want or whatever. You know, my daughters are looking at it at any given moment, and they buy it 6 months from now, when and if things seem to be more stable. So I would tell your listening audience to reduce unnecessary spending right now and just kind of pull in the reins until we get some sense of stability and what's going on.
Well, those are some interesting initial thoughts, Rick. A lot to dig into. A couple of different strings we could pull on. One, the speed of the algos trade that no humans can react to, but just the way markets have shifted. But I think you made a great point about different investing horizons, and somebody in their 30s can ride out the storm that, you know, the financial planners and institutional mindset for the last 50 years has been just to buy and hold. But for somebody that's in their 60s, 70s, or 80s that needs that income or is depending on the markets to feed them an income in retirement, it's a different ball of wax. I've talked to a lot of people that are actually in that boat the last couple of weeks. They're not sure what to do. The biggest question, Rick, over the last couple of weeks has been, where do you hide? If you think back just to one Friday ago, we're recording this on Friday the 11th, but if you think back to the 4th, the day before that on Thursday, people were out on the mainstream media saying, go ahead and hold. It said, we're going to figure this out. The tariffs may be a little volatility. And then look what happened that Friday. And now a week later, we've had a roller coaster ride. One would think that in these kind of turbulent markets, people would rotate into bonds. And I want to get you to weigh in on this, because they usually go to bonds, the dollar, and gold. The dollar's down. Bonds initially got a bid the end of last week, but then they reversed course and have been selling off, and rates have been going up this week. Really, the only safe haven that's been working is gold. But what do you make in particular of the reactions in the bond market, Rick?
So bonds look like, when they closed under 411 last Friday, 4.11%, which had been the prior low, that they were going to head lower. And they gap lower Monday morning, but that was the low. Now, you guys get my reports, and you know, Monday morning on a daily chart, bonds got the TNX. So this is inverse to bond pricing, the TNX, which tracks the actual yield. So the yield chart got a buy signal on Monday's open. So it kind of nullified the thought that the weekly chart was suggesting breakdown. Enough so that you might not have bought the yield chart or sold bonds, but you certainly wouldn't have played the sale in bonds, knowing the models. And this is what I, have told my clients. Yields today got up to, hold on, let me just pull up the chart, because where they got to today was the last kind of resistance point, 4.58 or so, 4.59. This is the last resistance point on the chart until you get to the 5% high or so. That's the secular high. So it either holds here, or we're probably making new highs. And this throws if we get to 5% or above, and we get to the high, the secular high made, what was it, last year? It was probably like 23. You're in a whole different world of hurt now. The flight to quality for bonds is not working, obviously. Where do you put money? What your question is? You put it in high yield savings. You can still get 4 to 4.5%. Forget going to the money center banks like Chase and Bank of America. They clearly don't want your cash. And you're saying, what bank doesn't want my cash? A bank that pays you 1 basis point doesn't want your cash. So you go to bankrate.com, you look at where you can get the most amount of money that is not tied up over time right now, and that is still most likely the best place to put your money if you pull it out of the stock market. I'll take right now a guaranteed 4.5% in a time of total disarray in the market, then putting it in the stock market and hoping that what Trump's doing is going to work anytime soon. And look, as is often the case with this president, I don't necessarily disagree with the thought process of what he's doing. It's almost always the implementation, how he does it, that's wrong. And in this case, look, if the U.S. has been taken so advantage of over time by countries charging us tariffs on our products and us not charging them, I'm not opposed to offsetting the tariffs. You're going to charge 10% to us? Okay, fine. We're going to charge 10% on stuff that comes into our country. It's how he goes about this. It's a full-scale implementation without looking country by country and just saying it's on everyone. It's some of the other things he's done where he eliminates whole departments of the U.S. government instead of looking at within each one, where can we eliminate, instead of just saying, well, let's just get rid of the whole thing. So again, I think every American likes the idea of cutting down on wasted government expenditures. And his team has shown tons of absurd amounts of money that have gone to causes that do not help the U.S., do not foster the U.S. Virtually no taxpayer would want our money to go to, implemented by several presidents in the past. So I think most of us are fine on the idea of finding the waste in the government expenditures and getting rid of it. But again, it's how he goes about some of these things that creates the big problem, not necessarily the idea itself. So going back to tariffs, I don't have an issue with placing reciprocal tariffs on countries and stopping the U.S. from being taken advantage of. But it's how he does it. It's the wholesale one that markets now don't know how to deal with, understand the implications of it over time. And if you're a CEO, how do you plan for the future when this stuff is, comes, goes, and now you're being said, you manufacture something overseas because it has traditionally been so much cheaper to do that than try to manufacture it here. Now you're being told, well, you need to bring it back here. First of all, can you even find the workers to go fill manufacturing, factory type jobs any longer? There's so many things here that make the future unknown that is, I think, why one need to contemplate how much exposure you want to have to the stock market.
Well, we're seeing everybody kind of reevaluate that. But Rick, in a bigger picture sense here too, if we're not seeing the typical safe havens in the US that investors have leaned towards, that being the dollar, that being bonds not reacting, and quite frankly, if we're seeing, in a way, kind of a loss of confidence in the US markets, I do get the argument that buying opportunities come from big market pullbacks and the lack of clarity out there for investors. But is this pushing the US and the US markets into a different realm here where US stocks always got a higher multiple than anything else around the world? Could that all change here and really turn what we know at the financial system and that playbook that has worked for decades? Could that change?
It could. It could. And look, I realize I'm not committing with answering like that. I don't know. We're at the forefront of potentially a change of the long-term outperformance of US over Europe or, Asia or emerging markets. It could. The dollar just spiked down today, made new lows, took out, we haven't been this low since early 2022, and yet it's bounced significantly. So it's still kind of in the trade. If we were to close right now, we're still within the range that we've seen for the last few years. And I can tell you this, and you guys know this because I send you my research. Early last summer, when the S&P was, 5,500-ish, give or take, I first started writing that if the S&P got to, my precise number was 6118, literally a precision number like that you want to greatly reduce your exposure to the stock market for at least a double-digit percentage decline. We got, I don't remember we got to within 0.5% on the all-time high of that level. And then we sold off 10%, we stalled, and then, tariff stuff came, and then we fell another 10%. But before we fell that second 10%, I was in print saying, if this doesn't hold, and specifically it was the 547 level in spiders, if that didn't hold, we would fall to the low 480s. And as of the current low of this move was 481.80 in the spiders, where I had my own resting bids scaled down there and bought currently at the lows of the move. So I've sold the high and bought the low in print before the market ever got to these levels. So you can take advantage of this if you've got the right models and the ways of interpreting where people panic the most and when they're positioned the worst way at any given time. So I honestly, I don't know a single person else on the street who months before we got to the high said, that's where you want to reduce exposure. And then weeks before we got to the low said, this is where you want to put it back on. But this is all assuming that the current highs and lows stay what they are. If we take out the lows, then, it could be a little BS type minor thing, but if it's more substantial, and this really ends up being, if the market's going to adjust price earnings multiples and forward earnings estimates, which were priced for peak performance starting this year. In other words, the current estimate on the earnings on the S&P 500 was $270 a share. And we were running at a multiple of about 22, which is traditionally well above normal. If we go back to a more reasonable level of, let's say, 18 times earnings, and the current estimate of 270 is even off by 10%, and the real earnings come in, so 270 minus 10% is, so that's 27, so 243. you get a target. 18 times the 243 gets you just shy of 4,400. So that means the market could still fall another 10% beneath what this year's low already is. And it's just a matter of, is that going to play out over time or not? And we don't know, given what Trump does or doesn't do at any given moment. Rates moving as high as they did this week was certainly not anticipated by bond players. And I have a very significant institutional client who runs a massive fixed income fund. He's a mutual fund portfolio manager. And, what's happened this week is, comes out of left field and just changes the game in a matter of days. I think I bought some bonds today because, to me, we either hold here or everything changes in the bond market. And then we go to 5% or higher in, 10-year terms. I actually bought some muni bonds today. You've got to be able to think in terms of, when does it feel like there's max pain out there? Am I willing to take the chance to go counter trend to where that max pain is being felt? And what's my own risk parameters around that to say, well, maybe the reason there's pain is because there's going to be a lot more coming. And each investor has to decide for themselves what they're willing to do. Do they have the tools, or do they have someone like me as a resource? Again, I have the institutional side that I run a whole business, and I have the retail side through intheknowtrader.com, where clients subscribe to. I have a daily newsletter and a weekly newsletter where I put out the thoughts I'm telling right now on air into specific ideas, and we go through each one of the markets, and I lay out kind of what I'm seeing, and at least I'm there to help clients navigate what's going on here. I can speak to you guys in a half-hour interview and give some basic ideas, but to actually get levels and how to and when to do this stuff, the average investor doesn't have the help they need. And unfortunately, I'm going to tell and say something that they don't want to likely hear, but they're most, and again, I'm not going to say all because there are some good ones out there, but most financial advisors simply are money asset gatherers who make a cut for you to keep your money in the account. And that's what they're trying to do. Because how many, let me ask you this, and again, I can't poll your listeners because I'm not talking to them other than in a very large way here through an interview. How many of your money managers materially reduced exposure in the last few months, as I had recommended doing? And it's probably not 15%. They don't know how, it's not their game, and it costs them personally money to do that. So there is that inherent conflict. They want to do right by you, but they also want to do right by themselves. And doing right by themselves is often directly in opposition of what's best for you.
That's such a good point, Rick. And I think that it also highlights the strength that you play to when you look at not just what's happening in the markets as far as the macro, but you're looking at quantitative models, technical analysis. You're looking at the psychological side of trading and incorporating all those different data sets into your thesis. And there are times to sell, there are times to reduce, and you did have a great call there. And I think people that have been following you on our show, or people that subscribe, which I do recommend checking out, could have seen your forecasting and your advice well in advance. I guess I just want to bring in one other sector here. I know it's not a sector that you put a lot of weight on, but our audience does put a lot of weight on the precious metals, Rick. They have probably an outsized allocation compared to, I guess I would say, normies. And so gold has done well. It has diverged over not just the last couple of weeks, but over the course of 2025 here. It's been going higher while the markets have been going down. If you look at the Dow to gold ratio, or you look at some of those ratio charts, you've been seeing a divergence. It has actually acted like a safe haven. For those of us that are crazy gold bugs in the audience, what would you do now after the run you've seen in gold? Would you start reducing it down and then maybe play these counter trend moves back into some of these buy the dips? Or how are you looking at the precious metals complex?
So the low, I think it was, let's see, Friday, until 5 day, Monday of this week was just above the 50-day moving average. It came back to what the highs were in February. I'm looking at COMEX Gold. And even though you introduced this with saying, that it's a sector I don't put much credence in, it's actually not true, because not only do I own gold, but it's something I write about every week. So I do watch the gold market. I can tell you, tactical upside targets were near, and let's call it 3277 up to 3301 is just the near term targets off of action basically started on March 1st. I like gold long term. I think all the fundamentals still would point to higher gold prices. And even if it pulls back, it would take a lot to change this from not being a bull market. It's one of the only bull markets you find on charts. And I told you this, guys, in real time. I had lightened my gold exposure at around $2,700. I had taken 50% off at around $2,700, and I put it back on that last day of February, but I only put half of the half back on at 28.50. So I missed some of the upside, but I'm still long gold, and I think gold, is still a market to be in long term. I am in touch with and talk to by telephone the largest gold portfolio manager in the world, and I think the fundamentals are still there for long term performance. But like any other market, you've got to know, positioning and understand if, when, and if. And so would I go buy gold at $3,250 an ounce now? Probably not. But I like to buy when there's blood in the streets, and I like to sell when everybody's euphoric about something. So I don't think everybody's euphoric about gold. Central banks are still buyers of gold. And I think, it's not crazy to think gold's going to $4,000 an ounce. It may even go to $5,000 an ounce over time. But you've got to deal, it's still a commodity. You've got to deal with the swings and stuff that take place in commodity markets. So if we ever got down to, 28 to 20, I don't know, 650 again, probably a great place to buy it. Right here, right now, tough to buy gold. And what I tell people, I've been telling people this for years, when you get a market that's ripping to the upside and you want to be involved, but we all want to kind of buy on a pullback and the market's not giving you a pullback, what I've often suggested to people is buy a third of the position that you were going to do. Put like a starter position on. If it falls, then fine. You still have 2/3 of your money to at least be long when you want to on a pullback. But if it just keeps going up, you've got no exposure at all. So put on something where it's not enough that you're going to lose sleep at night if it goes against you, but at least you're making something. If you think gold's going to $4,000 an ounce, then you put a little bit on. If you think it's going to $5,000 an ounce, you put a little bit more on, but you still leave enough to buy pullbacks. They always happen. It's just a matter of when and if you have the ability to time it. So I'm not a fan to pay $32.50 an ounce to first establish a gold position. But if you have none or you're looking to add and you just haven't, so you put a little bit in. And again, figure out the point where you're not going to lose sleep. You put in something where you're not going to lose sleep if it goes and drops 10%. But at least it gives you something. Because too many of us miss big moves because we're looking for pullbacks that don't come. And by the way, we started the show and the S&P was up 34 points. Now it's up 72. Right? So it's doubled its gain. And it's this, and it's midday. Still lots of time left today. Who knows which way we're going to close?
Isn't that the real takeaway from these markets, though? Who knows where we close day after day, and then even who knows where we open up the next day. But you are right, though, Rick. When you see markets taking off, hey, you can be a trend follower, too. Don't put all your allocation in it, but at least have a little allocation in these markets that are going up. And right now, it really just seems to be gold that is the big benefactor there, and even the gold stocks that are carrying along too. So, Rick, thank you as always for your time. I find these markets so fascinating to talk about, and quite frankly, there is a lot of question marks in traders' heads, but right now that there is a standout market, that is the gold market, but there also could be some very good opportunities to buy the broad averages. We just need to see where this market is going to bottom and have a strategy when you're buying into that. Again, Rick Bensignor, president of Bensignor Investment Strategies. Click the link in the show notes to visit the In the No Trader website to check out some of Rick's retail and individual investment products. Rick, great chatting with you. Thank you so much for taking time on this weekend show. Everyone stick around. We're going to be right back for the second half of the show with Richard Postma.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Time to shift a bit of our focus now, a bit more to the precious metals. However, we're still going to get some more comments on the markets, especially focused on the charts. Again, I think during these high volatile times, as I've said, pay attention to the charts and also understand kind of what the big picture theme is that is happening with money flows. We are now chatting with Richard Postma, aka Doc. And Doc, the last time we had you on the show, back at the tail end of February, and boy, oh boy, a lot has happened since then, and a whole lot of positive action for precious metals. I would say maybe not the most positive action for the broad markets, for U.S. investors broadly, but look, back in February, we were talking about gold's potential to reach 3,000 and even how overbought it was just a couple months ago. You had outlined a scenario where gold probably did need a bit of a cooling down period. Well, gold cooled down for about a week at the tail end of February. Other than that, it has been up. And this week, a little bit of volatility again, but gold seems to recover faster than anything else out there. Doc, give us your assessment on the gold market, please.
Yeah, we're in the stratosphere right now, and we can see short-term pullbacks, and that wouldn't surprise me at all, because when you look at the long-term charts right now, we're way overbought, and we may drift lower here for a couple, 3 months, but that doesn't say we're done with the bull market, which I don't think we are, because the stocks have not responded, a lot of them yet, and that tells me we have a long ways to go in this bull market. But we are way overbought. But oftentimes you'll see in a major bull market like this that you can come back a little bit for a month or two, but still go higher. So I still say that you can get pullbacks here. That's all I'm saying. I'm not saying that this is the end of this bull market, which it isn't. But we are in the stratosphere, but the market's still looking strong. But the 12 and the 26 months moving average on the MACD are quite a ways apart, and that's often a warning sign that you can get, pullbacks, let's say, in a month, and you might have it for 2, 3, 4 months even. And that's a possibility, because a lot of these stocks, when we had the downturn in the Dow Jones, got pummeled rather heavily. And that tells me that they're going to be in a trading range for some time yet this year, possibly. And that tells me also that the gold market might become quiescent for some time. But that doesn't mean that the bull market's not over. That's pretty much what I'm saying.
Well, Doc, when you look at gold, there's no denying it's had an amazing run. I mean, just in the last couple of years, if we think about back to that triple bottom false breakdown back in 2022, it was at 1618. We've got up to like 3,200 recently. So it's doubled in the last couple of years. And really, it's added on $1,000 just in the last year. But when you look at gold stocks, when you look at silver, they've done good. They've had rallies, but not to the same degree as gold. Is it possible that you could see a scenario where maybe gold just trades sideways or just cools off a little bit, but the gold stocks keep appreciating and catching up, and that silver catches up? Could you see that environment where the gold silver ratio comes down? Could you see that as a possibility?
Absolutely. And why you could see it is just look at the price of oil right now. Oil, the price is negative, and I think it's going to get more negative. Well, that's one of the major inputs for costs for these miners. And a lot of them are starting to actually look like real companies by spitting out cash flow or gargantuan cash flow, which they've never done in the past. In fact, they're acting like real stocks for the first time that I can remember. And then people are pretty bummed because they don't seem to coordinate with the rise in the gold stocks. But you could see, or with gold price, but you could see the gold price turn sideways or even down a little bit and not necessarily hurt the miners appreciably. And in fact, this big downturn we had recently with the Dow Jones Industrials, where gold got whacked and a lot of the miners got whacked, I bought again on Monday. That's how confident I am in this gold bull, because even though we could get a pullback, I think the miners would hang in their trading range very nicely.
Hey, Doc, almost everything got whacked over the last few trading days, early in the week, even tail end of the week before, because of, I guess, everyone racing to the door. But the one aspect that I find so interesting, and when we do see big market sell-offs, we typically do see gold, and even the gold stocks bounce back the quickest and the strongest. But this environment right now, where it seems like gold is being viewed as one of the only safe havens. The dollar's going down. Bonds have not risen. We see yields very much stuck in a range. And US markets, man, oh man, it's just a whole lot of red on the screen in a wide range. Pretty much every sector, again, outside of the precious metals, especially gold sector. What does this mean to you? Have we seen this in history where the only safe haven, at least in the near term, that we're seeing money flow into is gold?
We haven't seen this in history, at least in modern history, at all. And in fact, gold is my number one bet, and it continues to be, because we're seeing a change in the world. We're seeing a transformation in the world as we know it. We are seeing the neoliberal international rules-based order coming to an end, and that was established after World War II. It's coming to an end, and you're seeing a transformation, and nobody knows exactly how this is going to work out. But the United States is no longer going to be the big man on the block all by itself. We're going to have to learn to get along with others and negotiate instead of just enforcing our will on everybody through or militarily and economically. That's coming to an end. And that's one of the reasons I think gold has done as well as it has, because you're starting to see major players purchase gold, and especially the central banks, because they know there's a major change coming, and the old order of things where the dollar rules supremely is coming to an end. That doesn't mean that it's not going to continue to be the reserve currency for a time, but obviously things have changed for the dollar, not only through BRICS, which is accelerating that whole system, but the fact that changes are being made by the current administration, which will not be favorable to the dollar, and that will only help gold. I might add that they're talking about a sovereign fund as well in the United States. What do you think they're going to start to put in that sovereign fund? You can bet that gold will be a big part of it, in my view.
Well, Doc, I think you're spot on as far as the central banks around the world buying gold in a way of preparing. It's their number two biggest asset on their balance sheet now after the US dollar, ahead of other currencies like the euro or the yen or the yuan. So it's interesting that the central banks have been loading up, and it seems like the world has been loading up on gold, because gold is up in every fiat currency on the planet. It's not just a US dollar story. It's Australian dollar, Canadian dollar, the euro, everything. Gold is up in all these currencies. That doesn't necessarily translate to everybody buying gold stocks, though. And so I think a lot of people understand and appreciate that gold is an insurance policy on chaos. It's an insurance policy on geopolitics and fiscal mismanagement, and it's doing its job. But I think a lot of people listening are probably invested in gold stocks, and they're wondering, the central banks aren't buying them. A lot of generalist investors aren't buying them. Do more generalists start saying, hey, maybe along with gold, maybe I should have some of the gold producers? Could you see that switch happening?
Well, if you look at some of the volume over the last 2 or 3 months, almost 4 months of some of these stocks, the volume has picked up tremendously. And I've been watching that. And then I saw the sell off on Monday, and I'm thinking to myself that, holy cow, was that volume telling us that these gold stocks have peaked when in fact they're low in comparison to what the gold price is? No, I actually think that people are starting to appreciate the precious metals site more. I think they're starting to look at it. And because it is such a small percentage historically to what's been held in the past, I think some big money is quietly starting to come into some of these stocks, and they're looking at them. And I think that's an excellent sign. Just look at some of the charts and the volume the last 3 or 4 months. For some of these stocks, it's tripled or quadrupled almost as far as the volume is concerned. So I think some strong hands are starting to take positions in some of these stocks very quietly. And I think we're going to, especially in the year, and I've said this before, a year ago, 2 years ago, I mentioned that I thought that 2026 could be the best bet as far as when these stocks really go ballistic.
So, Doc, what subsector of the stocks are you looking at? The majors, a number of majors have done really well. A lot of mid tiers have done very well. A lot of juniors have really just been left behind. But again, they're juniors. They sometimes don't even really have gold assets other than the gold in their name. So, what subsector of the stocks, if you are saying next year is going to be a banger year for these stocks, which subsector is going to do the best?
I've been purchasing mostly producers that are considered mid-tier, between mid-tier and upper tier. Those are the ones I'm focusing on. And then I throw a few bucks toward the juniors every once in a while when they hit a monthly lower Bollinger Band. But on a percentage basis, I'm really concentrating now on mid-tier that are actually producers, because I think they're the ones that are going to do the best as far as movement in this year or maintaining their positions.
Well, Doc, let's dive into those a little bit further then, because the mid-tiers are the companies that have the most growth compared to the seniors, which can't grow as much. And they also have the ability to do M&A deals where the seniors kind of have their hands full. So the mid-tiers, when you look at them, which ones get you the most excited? Is it companies with growth? Is it companies building mines? Is it somebody company that's buying mines? Which ones do you like the best?
Well, my number one that I've liked forever is Equinox. I've liked them for a number of years, and I've taken a position in them that's pretty good. And then on this recent pullback on Monday, on the opening, I purchased some more Equinox. I like the fact that they're producers of a good number of of gold, and I also like their merger with Caliber if that takes place. It has to be voted on yet, as we talked off mic. And I also like the fact that their management, and a lot of shareholders were disappointed in Caliber, but it was essentially a 1-to-1 share arrangement. But that tells me that the management at Caliber is putting their money where their mouth is, and that they feel that they can really make the mine that the summer is supposed to be opened successful, plus other mines that Equinox has. So they seem to have a level of confidence in their ability, and the number of ounces they're going to be able to put out in the next year or so is pretty impressive. And I think they have a lot of room for exploration of more potential gold. And so that's one of my favorite. And then there's others I like, especially in the silver sector. And I like Fortuna. That's another example of stock I like, and I've been purchasing over time. Another one is Silver Corp Metals, and another one is First Majestic. And then I like Coeur d'Alene a lot because they're spitting out a lot of cash flow, and I love their chart. because they've come off again, but they've rebounded. But it looks like Coeur d'Alene is going to trade in that range for a while yet, but it allows me to keep picking up shares whenever they move down. And I think Coeur d'Alene is not ready to break out yet, but I think looking at their long-term chart, that their odds of breaking out are pretty good in 2026 based on what I'm watching.
So when you're looking at these producers, what do you put more weight in, or how do you rank certain fundamental factors when you balance out costs? So do you care that it's a lowest quartile producer right now, or because the price is higher, are you okay with cost being somewhat higher? Do you look at total ounces being produced or a certain makeup of those ounces? Since you did touch on silver stocks, those aren't just purely silver plays. And then how do you discount, or do you even discount jurisdiction in this environment? How do you rank those different fundamental factors?
Jurisdiction always bothers me, but sometimes I think it places us in a position where it scares us out of a potential mine that we shouldn't be pushed out of. And I know a lot of people look at jurisdiction, and it is important, but if they have other mines that are productive and that are good producers, I won't weight it as much as if it's their only mine in a questionable jurisdiction. And that's one of the ways I look at that, Corey, is if they were a lone producer in a questionable jurisdiction, then I would be uncomfortable with it. But if they have other good mines and that are good producers in other good jurisdiction, I don't consider one bad jurisdiction as something to keep me from purchasing a particular company.
Yeah, good points, Doc. I mean, all the companies you just mentioned could be considered jurisdictional risks. Silvercorp's in China, and they just bought another project in Ecuador. Neither one of those is a top tier caliber that we're talking about. Operating in Nicaragua, Equinox has mines in Brazil, along with their domestic companies mines. So you look at some of these producers, Mexico for silver. Most of them are in Mexico. So you pretty much have to be okay with Mexico risk if you're going to be in the silver stocks. So do you look at other things like growth or how much output they have, or is the expiration more important? What other criteria out of the ones Corey went over do you weight heavier than others?
I also like producers that have a big land package. I think the number of hectares they have is very important. That's number one. Number two is, you have all these criteria. Is good management that in the past has been successful. To me, that's very important. And number three is the grade that they're dealing with. Grade to me is awfully important. And those are just three that I really put high on my list as far as when I look at the fundamentals. And then I throw that in with the technicals. And I always try to purchase on pullbacks. And I'm a long-term holder now. I'm not selling anything of what I own, particularly right now. And I know we're going to get the big run coming up. And I talked about this would be a stair-step procedure. I talked about that back in 2021, where no, this is not going to be a V shape for these miners. It'd be a gradual, and that's what we're seeing. But we're going to get to the point where we're going to have a big blow off in the gold price. And you're going to see these miners really take hold. And I think we're starting to see that with the volume coming into this area on some of these companies. But it sure is different from the past, where you had mines that were really sloppily run, but they would have these huge price runs. But now we actually have gold at prices where these things are profitable, and they just seem to sit there. But they're going to have their day. It's coming. And I think what it's telling you is the fact that they haven't seen that last rush yet with the juniors. It's telling you that the gold price is going to stay up in this area and probably even proceed further in the future. That's what it's telling you, that we're not anywhere close to the end of this gold bull market.
Yeah, that's one thing I just keep on watching is that I know everyone wants their junior stocks to run, but when those things pop and just explode higher, that is usually very much the end of the cycle for a bull market move in the precious metals. Doc, I want to ask you about one other commodity that we've talked about a fair bit. It's copper. Copper went on a run not all that long ago to well over $5 and then immediately gave up about $1. It's been volatile as can be. The one thing that stood out to me is that even when copper was running up to over 520, the stocks weren't doing anything. And right now, you look at something like COPX, Copper Miners ETF, that's at multi-year lows. It is completely broken down. And quite frankly, it just didn't confirm that move in copper. What happened in the copper market in your eyes?
Well, I think it's because you're not seeing growth right now in a lot of these countries and in the US too. I think GDP is really going to be disappointing for this first quarter, and it's going to be coming out, but I think it's not going to be a good GDP. And I think copper is signaling the fact that there's not a lot of growth going on. So that's all it's doing. And really, copper is not in a bad situation, even though it's sold off. It's in a trading range as far as a monthly chart is concerned. So I'm not concerned about copper here at all. I think we could move back down to 350 to 375, and it's still okay. So the copper is not breaking down appreciably, even though everybody thinks it is. But when you look at the chart, it really isn't. So I think copper is just in a fine position. It's just biding its time. And it's going to for a while, because I'm afraid that we're going to see countries struggling as far as growth. Europe is in deep trouble right now. The United States, the GDP is not going to be good, I don't think, for the first quarter. And China's having its own problems. So copper, I don't think is going to go anywhere, either significantly up or down.
Well, Doc, let me throw another one at you in light of those comments on the macro side. What about the energy markets? Look at oil. Oil has just really fallen out of bed lately. It's broken down some of those price ranges it's been in. But the oil stocks, look at XLE, the ETF. Boy, that thing fell out of bed in the last couple of weeks. Do you think this is a key change for the energy sector that's longer term? Is this a buying opportunity? Does it have more to fall? How are you looking at energy and the gold and the oil stocks?
I would stay out of oil for a while, and probably for most of this year. I've been watching the stocks, and I'm starting to nibble a little bit in the oil stocks, but not to any big degree, because I think there's going to be pressure yet on oil. I think we're going to continue to move toward $50 to $40 a barrel in oil, and so I'm not gung ho about the stocks yet. Although like I said, I've nibbled. But it's more to make sure they're on my watch list than anything. But I will be purchasing. I'll be looking at them seriously, I think, as the year proceeds, because they'll be a great buy in the future, but not right now. I think there's going to be more down pressure on oil.
Is this going to be a U.S., maybe even global phenomenon here, at least in the near term, where pressure hits all these markets simply because of what's going on geopolitically, what's going on around the world, and quite frankly, the indecision markets hate indecision. They hate question marks, and that seems to be all that we have. So there's a lot of sectors that are simply just going to continue to lag until we get some clarity in terms of trade, even in terms of economic growth, that who knows when that'll be.
I think it's going to be that way for a while, Corey. I think we're continuing to see volatility and chaos throughout the world. This isn't a short-term thing. We're in a major transformation, and it's going to take time for things to settle down, but it won't be for a while. And there's one market I keep mentioning every time I'm on, and people better be cognizant of it, and that's the bond market. I have said before, and I'll say again, and I'll keep repeating, that people better consider the bond market, because when you look at the long-term charts right now, and this is right now, and it could change. I always have to qualify that, because people are so literal, that right now we have the possibility of a second leg down in the bond market in the next year, according to the long-term charts. Now that could change, but right now, and then you have to ask yourself, okay, why is that? What is it? And if people just consider the fact that we had this big sell-off in the conventional market, and guess what? The bond market didn't move. You would have expected it to turn more bullish, which it didn't at all. And that's telling you volumes right now that the bond market is broken. So you have to ask yourself, why would the bond market move back down with another leg down in the future if that happens? And that tells me that we're setting up for a really chaotic period of time in this country and the world. And there's a number of reasons why the bond market would respond the way it is.
Well, Doc, just to follow up on that, a lot of people have made the point for the last couple of years that after a 41-year bond bull market, it would make sense for there to be a longer term bear market in the bonds. But if that's the case, and if bonds keep going down, then that would mean rates would keep going up. At one point, you would think the Fed would have to jump in there and start doing QE again and buying those bonds, because otherwise rates are going to get to the point where it's bad for business and it's also bad for their balance sheet. So what's the balance there, or the rub there, between if the bonds are in a bear market and what the central bank will have to do?
Well, that's the problem now for the central bank is, as we often talk, there would become a point in time where the Fed would be between a rock and a hard place. Well, we're there. And there's a number of reasons for the bond market to sell off. One of them, of course, is that maybe inflation isn't going to go away like everybody thinks, even with a slowdown in growth. And of course, that's stagflation. Now, people would say, well, this past month's report was better than expected for inflation. That's true. However, I don't know if we're going to get back to the 2% level like everybody would hope. That's number one, especially with slowdown globally. And not only in the United States, but China and Europe as well. That's number one. And number two is in the bond market, there's a loss of confidence in the United States globally and throughout the world. There's a loss of confidence in the dollar. And what would get people to buy the bond market, especially if they're going to steal your bonds if they don't like what you're doing, or like with Russia as far as their holdings. And so there's a inclination for countries to start to sell off their bonds, and especially with all this tariff talk along with it. And I think you're starting to see that even Japan is starting to back off. So I think you have two pressures on the bond market, and I think they're going to be with us for a while.
Yeah, it really seems like this exit from the US, a trend that I've never seen in my lifetime, something that's really hitting home with me. Just even in the last couple of weeks here, seeing some of these market moves. Volatility is one thing, but the lack of any other safe haven aspect, especially on the US front, really sticks out to me. Doc, again, this whole breakdown in US confidence, right? It's something that I know gold bugs have talked about for quite a while. I've pushed back on that. Maybe it is happening now. This could be very early on. What do we need to watch out for that does really show us that a generational shift is happening in here in terms of money flows and in terms of something that would drastically change the overall makeup of the financial markets?
Well, I think you're seeing it in what we just talked about. And I think BRICS will continue. And in spite of Trump's threats to BRICS, I think they will continue to make the moves that they feel they have to become more independent of the United States. Their institutions like SWIFT and the IMF and the World Bank and all those, they are on their path to develop their own regional system of economic governance. And that's what you're seeing. So you're seeing that, and you're seeing the debt problems in the United States now finally hitting them square in the face. And so you have multi-factors. We're seeing a real change in this whole global system, and the neoliberal rules-based international order is coming to an end that was put in place after World War II. It's on its way out, and our hegemony is being compromised, and we have a choice to either try to negotiate with the rest of the world and get along with them for the first time in our history, or we can still think that we're trying to maintain our position and continue to shoot ourselves in the foot by sanctioning everybody and by militarily trying to compromise the people that don't bend their knee to us. And that's the choice for us going forward.
Well, Doc, just a quick follow-up on that. When you think about what a statement that is that you just made, I guess we were debating this off mic, but are we entering a situation where it's going to be inflationary because the whole world, not just the US, but China, Europe, everybody has to try to inflate their way out of this by printing more money? Do you see a scenario where we're hitting a deflationary thing where everything there's so little demand that the price of goods have to drop? Or are we in a situation where really gold is the only safe place to hide because there's nowhere else that has any growth even on the remote horizon? So what kind of a long-term macro environment do you see us entering into as far as how it relates to markets and in specific how it relates to gold?
I think that there's going to be a push-pull, tremendous push-pull between deflation and inflation. And ultimately, based on the Great Depression and the history of that, I think the central banks will always err on the side of printing more money if they have to. So ultimately, I think inflation wins out. And I think that's going to be the thing that will continue because every politician understands that they have to satisfy their constituency, and otherwise they're not going to have a job. And they will always err on the side of spending money. And the only problem is, how do you get out of your debt situation and still be spending money and still keep your economy going? And that's going to be the big question of the future. And I think the bond market is telling us that inflation is not dead at this time.
Boy, oh boy, what a historic week we just lived through. Volatility and some of the biggest market moves, even to the upside for something like the NASDAQ, the second largest move in history, and then pretty quickly almost given right back. Again, some of the biggest rallies do happen during bear markets, and who knows what's going to happen week after week, even day after day, since these markets in the short term are moving so much off of tweets and reports and rumors. The long-term trend, though, definitely does seem to have changed pretty significantly. How long that'll take to play out, who knows? But right now, as we've really driven home here, the main benefactor, one of the only benefactors, has been the precious metals, especially gold, and the gold stocks are doing quite well as well. Doc, thank you very much for your time on this weekend show. Everyone, thanks for tuning into this weekend show. Please keep in touch with Shad and I through email and through our website. Also, visit our YouTube page. Just search DKE Report. Make sure you like, subscribe, and comment on our podcast and YouTube. And also feel free to follow our Substack account, where you can get a summary of all of these interviews, really the highlight bullet points. Everyone, thanks for tuning in to this weekend show. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.